You've seen the reports. Dealer lots are full of 2026 models that nobody wants to buy. But the real reason these cars are sitting isn't just the sticker price, it's the $33 billion mistake hiding in the insurance bill. While the headlines focus on inventory, we're looking at the 39% premium jump that has turned these new cars into a financial liability. Today, we're exposing the actual math behind the uninsurable car crisis. In 2020, the American auto insurance industry was so profitable it returned more than $14 billion to policyholders in refunds and premium credits. 2 years later, that same industry posted an underwriting loss of $33.1 billion, the worst result in 50 years. For every dollar collected in premium during 2022, insurers paid out $1.12 in claims and expenses, and then your rates went up 39%. That 39% figure comes directly from the Bureau of Labor Statistics Consumer Price Index, tracking what American households actually paid between January 2020 and January 2024. Over the prior 5 years combined, that same index rose 27% total. The swing from record profitability to record loss and the premium surge that followed only makes sense once you understand what kind of market this is. Auto insurance is a product you are legally required to buy in 49 states, regulated by 51 different jurisdictions with no federal oversight. State-level insurance regulation traces back to the McCarran-Ferguson Act of 1945. Today, only New Hampshire allows drivers to opt out, and even there, most people who cannot post a $25,000 bond choose to buy insurance anyway. What this creates is a captive market. The Consumer Federation of America has argued for years that because auto insurance is legally compulsory, the pricing discipline that competition normally provides does not fully operate. Responding to a 30% price increase by declining to purchase the product is not an option, and that constraint produces a specific feedback loop that runs through everything that follows. When premiums rise, a portion of drivers drop coverage entirely rather than pay. For the household where the renewal notice arrives the same week as the electric bill, the mandate produces a choice the system never intended to require. The Insurance Research Council tracked this pattern closely. The share of American motorists driving uninsured climbed from 11.1% in 2019 to 15.4% by 2023, a 38% increase in the uninsured driver population over 4 years. More than 1 in 5 drivers were uninsured in 8 jurisdictions by 2023, including Florida, California, and Washington, D.C. When more drivers go uninsured, the remaining insured drivers absorb the cost of accidents caused by uninsured motorists, which increases claims payouts, which increases premiums, which pushes more drivers out of coverage. The very mechanism meant to protect everyone on the road can accelerate its own unaffordability. That feedback loop is the structural backdrop for understanding what happened to an industry that went from returning $14 billion to losing $33 billion in 24 months. The 2020 pandemic collapsed driving, and when driving collapsed, claims disappeared. Auto insurers suddenly found themselves collecting premiums against a risk that had temporarily evaporated. The refunds that followed were not generosity. They were an actuarial response to windfall profitability. 2 years later, driving had returned, but something else had changed. The average cost per private passenger auto claim crossed $10,000 for the first time in 2022, then rose another 11% in 2023 to nearly $12,000 per claim. The math that had worked in 2020 inverted completely. AM Best, the insurance industry's primary rating agency, reported a combined ratio of 112.2 for the personal auto sector in 2022. That ratio is the single most important number in insurance economics. Total claims and expenses divided by total premium collected. A ratio above 100 means underwriting losses. The 2022 figure ran approximately 10 percentage points worse than the 10-year average and surpassed the previous industry high of 109.4 set in 2000. State Farm alone reported auto underwriting losses of $13.4 billion that year, nearly 3 times what GEICO and Allstate lost combined. Of the 4 largest auto insurers in America, Progressive was the only one to post a combined ratio below 100. Losses at that rate, unseen in half a century, demanded correction. The premium increases that followed were not random. They were the direct financial response to a $33 billion hole in a market where the policyholders had no legal option to walk away. The question most coverage of this topic never answers is why claim costs exploded. 3 factors drove the increase, and only one of them gets any public attention. Vehicle prices came first. The Manheim Used Vehicle Value Index hit an all-time high of 257.7 at the end of 2021, up 53% year-over-year at its April 2021 peak. When a vehicle's market value rises, the threshold at which an insurer declares it a total loss rises with it. Cars that would have been repaired in 2019 were being written off as totaled in 2021, and the payouts grew larger because replacement costs had climbed. Parts and repair cost inflation drove the second factor. Between January 2020 and January 2023, the Consumer Price Index for auto parts outstripped auto insurance rates by 25%. The motor vehicle repair component of the CPI jumped 19.2% between July 2022 and July 2023 alone, a year when overall inflation sat at 3.2%. And then there is the factor that almost never appears in mainstream coverage: the cost of technology inside modern vehicles. Advanced Driver Assistance Systems, or ADAS, are the cameras, radar sensors, and ultrasonic parking sensors now standard in most new cars, and they have created an entirely new category of repair expense. A December 2023 AAA study examined 3 vehicles Americans actually drive: a 2023 Ford F-150, a Nissan Rogue, and a Toyota Camry. The findings explain what happens when any of those vehicles gets into a minor collision. In a front-end fender bender, average repair cost for these systems hit $1,540, representing 13.2% of the total estimate. Minor rear collisions averaged $684 in sensor repairs, but that figure represented 40.9% of the total bill. The AAA study found that these components can add up to 37.6% to the total repair cost after a crash. The specific dollar figures tell the story. Replacing a front radar sensor runs $500 to $1,300. A windshield camera sensor costs $900 to $1,200. Side mirrors with integrated cameras run $740 to $1,600. All of that comes on top of the bodywork, not instead of it. Every sensor knocked out of alignment must be recalibrated. CCC Intelligent Solutions, which analyzes actual insurance claims, found that the typical vehicle now requires 1.7 calibrations per repair, with dealer calibration charges ranging from $46 to over $12,000, depending on the vehicle and work required. 90% of new vehicles now ship with at least one of these systems. A parking lot fender bender that cost $800 to repair in 2015 now triggers mandatory electronic recalibration on top of the bodywork. Physical damage may look the same as it used to. The invoice does not. The industry knew by 2022 that it was losing $1.12 on every dollar collected, yet your rate increase did not arrive until 2023 or 2024. The answer is a regulatory system that was already slowing down before the losses materialized. When costs rise, insurers must file for rate increases with state regulators. 38 states and the District of Columbia allow insurers to implement new rates immediately after filing, subject to later review. The remaining states require prior approval, meaning regulators must sign off before any change takes effect. The Insurance Research Council published a study in January 2026 documenting what prior approval actually produces. Average days to secure rate approval in prior approval states increased by 40% between 2010 and 2023. Filings withdrawn, meaning not approved, rose from 1,900 to 3,200 annually over that period. The share of filings approved at lower than requested rate levels grew by 10 percentage points. California provides the clearest illustration of what this produces. Under Proposition 103, passed by voters in 1988, the State Insurance Commissioner must approve all rate changes before implementation. If an insurer requests more than 7%, consumer advocates can intervene as parties to the proceeding, a process that can take years and requires the insurer to pay the intervener's legal costs. Not a single auto insurance rate filing received approval in California from May 2020 until October 2022. During that same period, more than 75% of auto insurers in the state filed for increases. When Allstate finally received approval in October 2022, it came in at 6.9% despite a request for 15.8%. 226 days is the average processing time for an auto insurance filing in California, the second longest in the country. Between 2018 and 2022, California ranked 50th among all states in the number of auto insurance rate filings, dead last, while simultaneously being marketed as the state with the strongest consumer protection law in the country. The consequence is that when adjustment finally comes, it arrives all at once. Drivers in California saw increases of 40 to 54% in 2023 and 2024 as insurers played catch-up on years of suppressed rate filings. The regulatory buffer did not produce lower long-term premiums. It produced the same premiums, delivered as sudden shocks rather than gradual adjustments. Beyond the cost of claims and the pace of regulatory approval lies a third layer. The factors that determine your individual premium, collected by parties you may not know, are watching, processed by formulas you cannot see. Reporting in 2024 revealed that General Motors had been sharing driving data with LexisNexis and Verisk, companies that provide risk scores to insurers through its connected vehicle systems. Drivers were unaware their braking patterns, acceleration, and speed were being collected and sold. General Motors suspended the program following the reporting, and Hyundai discontinued a similar program in April 2024. Texas Attorney General Ken Paxton filed a lawsuit against GM in August 2024, alleging the company sold driving data without driver consent. Most major insurers now offer telematics programs that track driving behavior through smartphone apps or devices plugged into the vehicle's diagnostic port, and approximately 12 to 14% of policyholders actively use them. The discount those programs offer has been used to normalize data collection that policyholders cannot audit or opt out of without surrendering the potential savings. The telematics layer is new, but it operates on the same structural principle as a pricing input that has been embedded in auto insurance for decades. 4 states prohibit insurers from using credit-based insurance scores in auto pricing: California, Hawaii, Massachusetts, and Michigan. The other 46 permit it. A 2007 Federal Trade Commission study found that credit scores effectively predict claim frequency and total payouts, and that this relationship held even though there is no demonstrated mechanism explaining why bill payment behavior for non-driving expenses would cause accidents. The premium you pay reflects inputs you may never see itemized: your credit history, your zip code, your occupation, your education level, and potentially your actual driving behavior, collected through systems you did not know were watching. None of these inputs are disclosed in a form that allows a policyholder to audit how they shaped the final number. After 2 years of double-digit increases, the personal auto insurance industry achieved a combined ratio of 95.3 in 2024, its most profitable result since before the pandemic. State Farm reported a 2025 underwriting gain of $4.6 billion, reversing its prior year loss. The correction worked. Premium increases outpaced claim cost growth, and the industry returned to profitability. National average rate increases for 2025 are forecast at roughly 7% by the Insurance Information Institute, down from 14% in 2023. Insurify data shows average prices actually fell 6% in 2025, the first meaningful decline since the surge began. The share of drivers who described their auto insurance as unaffordable dropped from 38% in May 2025 to 32% by December. None of the structural factors that drove the 2022 to 2024 surge have reversed. These systems continue to spread into more vehicles. Repair labor costs continue to climb. Climate-related claims show no sign of declining, with hail damage representing 11.8% of all comprehensive claims in 2023, up from 9% in 2020. Auto parts tariffs enacted in 2025 will add to repair costs. The magnitude has not yet been measured, but the direction is established. The feedback loop between rising premiums and rising uninsured rates, which added 4 percentage points to the uninsured driver population between 2019 and 2023, has not been broken. Industry projections for 2026 sit at roughly 4% average increases. That is not a return to pre-pandemic pricing. It is a slower rate of increase after an abrupt correction. The 2022 to 2024 surge was a correction, not a change in the system. There is no normal to return to, only a new baseline that will be periodically recorrected in a market where you cannot choose not to participate.